Welcome, folks. I'm assuming there are folks coming in. Be kind of silly, Roger, for you and me to talk to each other about this. I'm happy to.
Yeah, it's fine. Yeah, we're gonna get folks like 1 or 2 more minutes as is standard. This is like the awkward period where people are logging in. While we're killing time, while we're doing this 1 or 2 minutes, while people start to log in, I am going to encourage folks to fill out. I'm going to ask one of my colleagues to drop the link to the annual T3 Insider Information Tech Survey into the chat. And this comes out every year. It's valuable. Obviously, it's valuable for tech vendors such as ourselves to understand like what's going on out there with different tech products out there. But I remember from my days as a financial advisor, it's a useful document for financial advisors as well to understand what's up and coming, to understand where the profession is in terms of what they use in their tech stack. I hope that you will consider, I don't know, I wouldn't say do it in the background during this call because you're going to want to have your full attention on me and Ben. But maybe if you can multitask, you just pop up that survey in the background and you could fill it out as you go. Because, like I said, it's super valuable to the profession. Yes, there's an element of get out the vote for that thing where you'll hear every tech vendor under the sun trying to get their people to fill it out. I feel weird about that, so I'm just going to say do it because you're helping the profession get better information about what's going on with the different tech products out there. So I'll leave it at that.
Yeah, I like that. And so I think one of our colleagues did put that link in the chat. Just so y'all know, the chat's disabled because there's going to be like 4 million people on this webinar. That might be a gross overestimation. But we are taking questions in the Q&A portion. So we've got some of our other Holistic colleagues in there to answer questions as they come along. So go ahead and put your questions in there. I think we can probably go ahead and get started.
Yeah,
We
do
actually
it.
we started with a slide this time. For those of you who participated in the webinar that Roger and I did, was that last month, maybe a month and a half ago, about Tax Report 2.0, we realized the marketing people said, do you guys realize you never introduced yourselves and said who you were? So we've only been doing this for a few years, but so that's why we have a slide up on here to say, I'm Ben Birkin. I'm the Vice President for Customer Support here at Holistiplan, joined by Roger Pine, CEO and co-founder of Holistiplan. Roger, how are you this afternoon?
Yes, good. Ready to talk about Roth. I'm pumped.
Wonderful. We are going to talk about Roth. The title of the presentation is Advanced Roth Conversion Planning with Holistiplan's multi-year Roth Projection. So we're excited. We're going to walk through our new multi-year Roth Projection tool. Just a little bit of housekeeping up the top. We already talked about the Q&A box. For those of you who are dying to know, we are recording this webinar. We record every webinar we do. We record some of the webinars we don't do, but we definitely record the webinars that we do, and we send links out within a couple of days. You might not get this one right away because there's this weird little holiday thing coming up, but just rest assured, you will get a link to the recording of this. So don't worry about scribbling everything down. You will get a recording in your email inbox. That's our Thanksgiving present to you. So Roger, let's just, before we even jump into what we're going to do, here's our agenda, by the way. We spent a lot of time working on this agenda, guys. So we're at number 1 already. The background, right? We'll talk about a case study, we'll go through a demo, and we'll talk about next steps. But just big picture, before we even get into details, why are we spending so much time talking about Roth projections, Roth conversions, having tools for people? I know the answer, Roger, but I'm curious to hear from you. Like, why have we spent so much time kind of diving in on this Roth conversion story?
Ooh, put me on the spot. I mean, the answer, at least in my mind, is like Roths are probably the primary thing that people are using Holistiplan for once they get into this scenario analysis world. I mean, it's such a classic example of how you bring income into I mean, tax planning is all about bringing income into a year or pushing income out of a year. And Roth is your best way to bring income into the year because not only are you bringing income into the year, you're creating this tax-free asset that you have for the rest of your life. So we've just seen a ton of people do stuff with Roths in our system. And over time, we've kept adding more and more functionality in order to address the needs of people doing Roth conversions, Roth analysis in the system.
Yep, absolutely right. So good answer.
Thank you.
As the person who sees, almost every ticket that comes into Holistiplan, far and away, the biggest question we get asked is, how do I model a Roth conversion in scenario analysis? And while there are tools to help you explain, and we'll always tell you, here's how you do it, that next step became, well, how do I help my clients better understand why I'm doing this in the first place? Right? So why am I doing a Roth conversion at all? Roger, gave the financial planner's definition. I'm bringing taxable income now. In exchange, I get tax-free income. But, I think it's important to realize clients understand this when they see that first tax bill after you do a Roth conversion. That's not free, right? There is a cost involved, and you have to, I think, in some way, talk about why you're doing it,
Yeah.
justify why you're
I'm
doing it.
creating more taxes for you. There has to
Exactly.
be a good understanding on
Trust
the
me.
client side
Yeah,
on
trust
why,
me. It's
beyond
just
just
going to work
trust me.
just
Yeah.
fine, right? Yeah.
Yeah.
So, I think we're going to use a case study here. We're going to
Ooh,
start. I know, I apologize. A lot of
so many
words on the
words,
screen.
Ben.
There's a lot of words. Again, we blew the slide budget on the agenda slide, so we had to put it on here. So I apologize in advance. Yes, there are a lot of words. This will all come. This will all come with a good payoff, I promise. So we've got, as typical, if for those of you who have been Holistiplan folks for a long time, we've got some alliterative names in our example. This is Ryan and Rachel Roth. Ryan and Rachel are both miraculously born on the same day, right? May 1st, 1958. So they're 66 years old. They retired earlier this year. Ryan's already collecting Social Security. He's got a benefit of $25,000 a year. He also has a small pension. He's one of those rare folks that somehow has a pension of $15,000 a year, no cost of living adjustment, so no COLA, but it does have a 50% survivor's benefit to it, which is going to be important because we think, 2 bullet points down later, Ryan's not going to outlive Rachel. In fact, it's going to be the other way around. Rachel's going to outlive Ryan by 10 years, or so we think. They're going to delay collecting Rachel's benefit until her age 70, which is in 2028, where it's projected to be about $30,000 in today's dollars. They think they're going to spend, or they're going to try to spend, about $120,000. That's going to drop down to about 100,000 after Ryan's death in 2049. And then this year, this will become important in just a minute, but they've got some investment income in addition to their pension and Social Security of about 10 grand in dividends, 8,000 of which is qualified, $2,500 in taxable interest, and $15,000 of long-term gains in this current year. That's going to help get them to that $120,000 amount, right? The details in these are not real people, right? We're obviously putting together some things, but it's intentional, right, to show some of the capabilities of what the Roth tool can do.
And this is the classic primary strategy that people use Roths for, is those years between retirement and the years when you're taking Social Security and or starting to take RMDs. Those like 5 to 7 years where typically someone who's got a lot of assets but is somehow for this rare occasion is in a lower tax bracket. Very common case where we're looking at Roths.
That's right. And, to just piggyback on that a little bit, we've got their account balances here. So another good example of why you might want to do Roth. Ryan has accumulated a sizable traditional IRA balance of about $1.75 million. Rachel's is a little bit smaller at $750,000, and a joint brokerage account of about $600,000, of which there's cost basis of $400,000. So again, we've got large IRA balance, a couple of years before we have to start taking required minimum distributions, which we know are going to start maybe relatively small, but will grow over time. So here's our golden window opportunity of getting money out, taking the tax hit now when rates might be lower than in the future, and in the process, creating a pot of tax-free income. The question, of course, and this is where we started this whole journey, not just, tax planning wise, but in Holistiplan, is, well, how much of a conversion do I do? Right? Where's my breakpoints? How much of a conversion am I going to do? What makes sense? So we're actually going to jump out of PowerPoint here. Thank goodness.
Is that
Right?
the
If
end
I
of
can,
PowerPoint for this
that's the end of
entire
PowerPoint.
webinar?
That's it. That's all we had to
Okay.
do. Right? So you're all welcome. We're going to jump into Holistiplan, where everybody's much more comfortable, a lot fewer words too, right? And where we're going to start is actually in the scenario analysis tool. Again, we're going to get to that multi-year projection tool, but there's a whole story going on here about why we want to think about a particular dollar amount here and how we evolved, at least with Holistiplan's storytelling ability, about Roth conversions. So we've already got, this is, again, we're assuming this is a brand new client. We've got all of the pieces that I just described inside the scenario analysis tool in terms of income for this year. So here's our interest, our dividends, the amount that was qualified. Here's Ryan's pension of about $15,000, gross Social Security of about $25,000, not all of which is taxable, right? So Holistiplan will calculate how much of that Social Security benefit is taxable based on the other income going on here, and the $15,000 of long-term capital gains. right? Now, you don't even need us to tell you this is a relatively low income person, right? In terms of, how much taxable income there might be in terms of a really low tax bracket. So sets
Ben,
itself
you got
up
a
well.
request to zoom. Are you able to zoom in a little bit?
I sure can. Let me do that over here. Is that a little bit better?
Maybe. I don't know. Someone said, can you zoom in? All
All
right,
right.
it's zoomed.
All right.
Thank you,
We
person
are
who
in.
asked.
Yep.
Yeah.
So
So we've made it a baseline. This is what your life is going to be like if you don't do a Roth. The client's like, sweet, I'm finally in the low tax bracket after 30 years of working in a high bracket. Finally, I don't have to pay taxes. And then suddenly Ben comes along and says, nope, I'm gonna make you pay some taxes anyway.
That's right, but I'm going to do it
How
for a good
much?
reason, right?
Yeah, yeah.
So the question becomes, how much? And that's where, if you're not familiar with Holistiplan's range calc tool, boy, are you in for a treat. We're
Mm.
going to jump to that range calc tool. What range calc does, or at least is intended to do, is show you the impact of adding incremental amounts of either ordinary income up on top or capital gains down at the bottom, and show you the marginal or the effective rate of adding that next $1,000, right? In this case, we'll concentrate on ordinary income because a Roth conversion adds ordinary income to your picture. And what you see here, there's a bunch of different colors, which we always are excited about. We're going to start by focusing on the blue, right? This blue, if you trace it along, and as I'm going from left to right, what I'm doing at this 0 point, I'm adding $1,000 to my baseline ordinary income amount of about $2,550. I'm adding $1,000. So each $1,000, I'm seeing what the tax rate is on that next $1,000. It's going to jump up from 10% to 12% right here. That's showing you the break point from the 10% bracket to the 12% marginal bracket, right? As I get to about 60 some odd $1,000, I'm still in the 12% bracket, but I've got this big red chunk right here. What's happening here is I've added so much ordinary income that I've pushed my taxable income up to the point where I'm now pushing capital gains out of the 0% bucket and into the 15% bucket. We've got tons of webinar content and knowledge-based articles and videos about this concept. So we're not going to spend too much time on here other than to just show you there are different things going on when you think about a Roth conversion than just somebody's ordinary bracket, right? Just their marginal bracket. So here we see by adding ordinary income, we're increasing taxable Social Security. You got to think about that. But here, what the concept we want to get across is even though you're in the 12% bracket, your effective rate on money in this as you're adding ordinary income is actually about 27% when you add the 12% ordinary income to that 50% capital gains. But in this case, we're going to say we don't care about that. We just want to go all the way up to the end of the ordinary income bracket, the 12% bracket, and that's at about $85,000 of additional ordinary income. So that's what we're going to target for our Roth conversion amount.
Yeah, I can add $85,000 of additional ordinary income without leaving the 12% bracket. And
That's right.
so that's what we're going to say the Roth conversion is. By the way, Ben, there was a question that came in. It was like, well, what about years when you're not in a low bracket? We're just giving one example of how you would do a Roth conversion analysis. There are other
Yeah.
examples. For example, someone who's 27 years old and in a higher bracket. There's probably a good reason for looking at Roth conversions for that person.
That's right.
Someone, yes, who is older with enormous amounts of retirement assets that they will never use, and maybe their children would benefit from them. Yes, you would potentially look at a Roth conversion for that. That's why we have a Roth conversion analysis tool. We're not going to show every example in this demonstration. Okay. We're talking about one example that we're running end to end about how you actually model the Roth conversion strategy. We'll get to that. But then here we're in we started in the middle of the story, which is how you implement or determine at a tactical level how much to fill a given bracket. Okay. We're kind of spinning, we're showing features rather than telling every story of how you would do or why you do Roth conversions.
Yeah. And that's just to
Yeah.
double
Thank you for
down
that
on that.
question. But yeah,
This is not like the best practices for analyzing every single Roth conversion analysis. This is just
correct.
a story, an example to allow us to show
Right.
how you would use the multi-year conversion tool.
And how the tools fit together, right? Because I mean, everything you've seen so far that Ben has showed is stuff that Holistiplan has had for like 5 years. It's like running scenarios, checking to see if I can fill a bracket, use range calc to visually see how to fill that bracket. That's what he was doing with kind of sliding his mouse across the screen to see where the top of the 12% bracket is. All of that existed. All right.
Yep.
Go ahead,
And
Ben.
we even
Sorry.
had, we had another tool, right? Which was, okay, so you can enter a Roth conversion of $85,000 for Ryan. And then we had this explainer tool, which would show you,
Yeah.
here's the impact of that conversion. on a
Right.
long-term basis, not just the taxes on this year, but the changes in portfolio values between doing a conversion and not doing a conversion.
Right.
And it was super cool. It still is, because you can put the actual tax basis, like everything that's happening in this scenario can be pushed over to that tool, but it had one significant limitation, which was it only showed 1 year of conversion. And if
Yeah.
anybody, go ahead, Roger.
Well, I'll double click on, and by the way, Ben, on screen, the $85,000 Roth conversion, we do that 13, you see that incremental cost of Roth conversions there. We actually in the behind the scenes run the tax calculation 2 times, one without and one with the Roth conversion. So we get the total cost, because you'll notice it's not 85,000 times 12% or 10%. It's factoring in the change. Ben showed how capital gains are coming online, some Social Security income is coming online. That's what's being calculated there. So actually the effective rate of that $85,000, you're paying 16% on it. People ask for a way. We gave them this for years, and they're like, that's awesome. I want a way to show long-term what the benefit of this Roth conversion is. And like for about 2.5 years, I resisted that call to show that, because I was like, that's a different tool, y'all. We're a tactical financial planning system. You can model something, and you can get the cost of the Roth conversion, boom. But these people were like, look, I want to see the long term. I'm like, well, we don't do that. We eventually built it because enough people asked. That's part of our job, is to listen to our customers. And they said, look, I want it all in one place. I want a way to demonstrate. Ben, you can start clicking into that if you want. I want a way to demonstrate what is the long-term benefit of doing this Roth conversion analysis. And what Ben will show, you don't need to go through it all because
I'm
it's a
not
whole
actually, yeah, I don't
thing.
want to stick around in here too long.
Yeah, there's a bunch of data entry, but
Yeah.
basically what we were showing, what we can show from this screen, which we built, was a model of, if this one Roth conversion that you do, here's the long-term benefit of doing it by putting in all these assumptions about returns, about inflation, about spending. Within 31 seconds of us building this, we got calls for like, I want to be able to model multiple years. We're like, oh shoot, well now you're just asking us to build a full-blown projection engine. And so that's what we've rolled out in the last few weeks, was a way to, on a standalone basis, model multiple years of Roth conversions.
That's
Right, Ben.
right. So to get to that, you actually don't even need to go through scenario analysis anymore. Once you have enabled this, and if one of my colleagues can put in the chat the knowledge base article that is specific to the multi-year projection tool, we lay out how to set it up, how to turn it on, so that this section will now show up in your client's household, right? It'll be south of scenario analysis, but north of cash flows. There will be a whole section in here that says Roth projections. To create a Roth projection, you click the Create Roth Projection tool. I've already got one built, but we're going to start from scratch just so that we can go through the whole process here. So we're going to call this Roth Projection Demo. And in doing this, we're going to try to see if we can spell it right. There's going to be a couple of questions you're going to have to answer. And some of these might seem a little silly because you're like, I'm already working with a client, but this projection tool, you could be doing a couple of things regardless of how you've entered these clients in the system. So as you're filling out some of these things, just know, we know some of it seems repetitive, but we also have to build for these edge cases where maybe you're only doing for one person, or maybe you're only doing for the other person. You want to do a different filing status. In this case, we're going to select, these are married filing, joint filing status people. These are the two people in the household for whom we are doing this. Again, you say, why are you doing that? Well, we have some people who put every member of their household, right? Not just the taxpayers, but the taxpayers and their kids. So we have to enter the stuff specific to the people we're doing the projection for. So in this case, it's Ryan and Rachel. We're going to start in the year 2024. We have the ability here, when we're doing this, one of the assumptions we have to make, we have to use the standard deduction. We don't have the ability to go in and fine tune the itemized deduction for every year in here. So we can easily add the over age 65 deduction to that because we know how old Ryan and Rachel are. What we don't know is if they're blind or not. So if your clients happen to be blind, which would entitle them to an additional amount of standard deduction, you would use these checkboxes to indicate that. We realize that the language for deduction blind is not the most compelling, but we struggled with what to put in there that wasn't just a full-on sentence. So we land in here, but know that that's what that's intended to be. It's so that if your clients are eligible for the additional amount of standard deduction because they are blind, you can check this box and we'll add it to it behind the scenes. And now we're going to create the Roth projection. Although what we're really doing
By the way,
is
Ben,
we're creating the
real quick,
shell. Yep.
Ben, there's a lot of questions coming in the Q&A about range calc. And so, like Ben said, like that is a whole, like we have an entire set of what we can, if there's enough demand for it, we can do a standalone webinar about range calc. We've had that for many years. There's a lot of good questions here about like, I don't understand what this is. Could you model this? Is state tax a thing you could show? The answer is yes. So like, there's like a whole lot of stuff we could do about range calc. It's an awesome tool. It's one of like the coolest things. If you're doing a lot of Roth conversion stuff in Holistiplan, we're not going to spend more time with it. That's like a whole other webinar. We're super proud of that screen. We could spend an hour on it alone, and we have.
Yeah,
So it's
and we
just like for
do. We
another
do like
time.
every month, by the way, every
Yeah.
month we do an all about scenario analysis and range calc tool.
Right.
So if you haven't, we've got recordings of it, go to the website, sign up for the next one. It's a fantastic tool. But to Roger's point, like we only showed that just to give an example of how
Yeah.
we came up with a certain dollar amount in this particular
Right. Right.
case.
It's the tactical manifestation. When what Ben is going through now is like we're coming up with a strategy for Roth conversions. And once you've established that strategy, we're going to fill the 12% bracket. We're going to fill the 22% bracket, whatever. Then year after year, when you're actually in implementation mode, you're using scenario analysis and range calc to actually do it. So, but we're at strategy phase now, which is not something Holistiplan did previously. That's what we're trying to show y'all.
That's right. Okay, so we are now inside the screen where we're going to build out this Roth projection. Remember, we'd said we targeted that $85,000 amount for the current year. We're going to say like that's actually a pretty good dollar amount for Ryan until he has to start collecting um, until he has to start taking required minimum distributions. So one thing that you're going to see here, and this will be consistent for any time we're going to add an income stream, there is a particular way that you're going to want to do this. We've tried to write this out in the directions up top, but we continue to get questions about it. Each row that we're going to add represents a series, in this case of conversions, that starts in the specified year and continues until you add a row or a year that says 0, right? So as we add our first row, we're going to say in 2024, we are going to do an $85,000 Roth conversion. We're going to increase that at the rate of inflation that we're assuming, which is 2%. Again, that's not Holistiplan's prediction of inflation. We don't have any idea what inflation is going to be. It is just a number that we are pulling. But what this is going to do is it will start adding, as I hit apply, Roth conversions of $85,000, increasing at a rate of 2% until I tell it to stop, right? And that's key, until I tell it to stop. And so I'm going to tell it to stop in the year 2032, because if I've done my math right, that's the year I believe that Ryan should have to take a required minimum distribution. Might be 2031. Let's back it up to 2031. At which point I'm going to say 0, right? And this 0 is what is telling Holistiplan, and you'll see this change right here, right? We are doing conversions all the way until we tell it to stop, and then that next year, right, in 2031, we're saying 0, right? These illustrations are intended to kind of help you see what is happening, right? So again, I'm doing an $85,000 conversion. It's going to increase at a rate of inflation until 2031 when I do a conversion of 0, and then I'm not going to do any more conversions, right? Again, just an example, not a good, bad financial planning strategy, just an example, all right?
It's
We
a
have to
good
add a little bit
strategy, Ben.
more.
Give yourself some credit. This is
Well,
good.
we'll see. We don't know if it's good or not. We
Okay,
haven't seen
you're
the
right.
outcome,
Maybe
right?
it's terrible. Yeah.
So let's add a little bit more detail here. This is the stuff that we talked about on that slide. So we've got $600,000 of assets with a cost basis of $400,000. Roger, why do we have to enter all of this in anyway? And I'm going to ask you to say why as I'm typing these numbers into the screen here.
Well, because you have to determine, what behind the scenes is an engine that's running year after year and trying to estimate how is the portfolio growing based on our return assumptions. And then also year after year, especially as if we're selling investments, how much capital gain am I needing to recognize as money's coming out of that taxable account? And so that cost basis allows us to determine how much of it's free to take out versus how much of it is not free.
That's right. So along those same lines, we have to enter some assumption about how much the portfolio is going to grow. Again, this is just a straight line projection. This is not, Money Guide Pro, eMoney, Navigable, any of those things where we're throwing in Monte Carlo simulations. We just have to enter some sort of return assumption in here. And it is a straight line assumption. We're going to say it's going to be a 6% return for these folks for reasons that only are known to their financial planner. On this section, we mark this as optional, but we also come in with a default number. Again, it is not our prediction or best practice. It's just there's a number in there. something to indicate that not every element of the return is going to be income or growth, right? It's usually going to be some combination of the two. And so what you have here is a setting, a field that says how much of your return are going to be capital gains and how much is going to be, the source of dividends, right? And the concept here is that capital gains aren't taxed every year until you realize them. Dividends are, right, if they're held in a taxable account. We're going to leave it at the 20% number, but that's, and I think, an important piece, right? And that you
Yeah.
can fine tune to yourself to what are appropriate for your expectations about returns and the
I wonder if
makeup
our
of those
default's a little
returns.
low even,
I
I would
think it
imagine,
is.
yeah.
Yeah, I mean, I think it's a little
It's
low.
more conservative. So like by having it low, you're going to err on the side of being more conservative. So you're going to have higher taxes on the interest piece, which is in this case 80% of that 6% return assumption.
Yeah.
I could
Again, I
argue it
just
could
want to,
change.
before we start, dealing with questions coming in, this is not scientific, right? This is not, our Roger's CFA knowledge coming into play. It's just a number, right? So don't read too much into that. Now about Ryan, we said he's only going to have a life expectancy until age 90, and he's already collecting Social Security here in 2024. All right. Now we have to do a little same thing for Rachel. We said Rachel was going to live till 100. She's going to collect Social Security. We said what, in 2028? So 4 years from now. And then her Social Security amount is going to be $30,000 expressed. It's today's dollars, $30,000 in today's dollars. I forgot
Yeah,
to
we're
put
always
mine in
entering
here.
today's dollars. It
Yeah,
automatically inflates based on our inflation assumptions on all these.
that's
And we
right.
can set different inflation assumptions. I remember it back in my financial advisor days, which are becoming more and more distant as the years go on. We'd have clients who were like, Social Security is not going to be there when I retire. And so we'd be like, oh, how about this? Well, how about we use a different inflation assumption for Social Security, like a lower inflation assumption for Social Security than we would for like spending and other things, right? So that was a way to kind of capture to some extent the belief, right or wrong, that Social Security may not fully be there when you and I retire, Ben. So like we could use a different inflation assumption for that.
Yep, and so that you actually can get to that in this screen, and we'll show you too, other places how you can change inflation assumption for different income streams should you want to. We're going to start with their spending assumption in 2024. Again, we're going to have an opportunity to change this once we get to the control panel of the projection. Here's our inflation assumption. Again, broadly, it's not applied to income and spending, right? Because we can apply different rates of inflation to this, but it is applied to the tax brackets and the standard deduction amounts in the tax calculation engine, right? So by saying 2%, we're going to say that the marginal brackets and the standard deduction, which we know for 2024 and actually know for 2025. Beyond that, we'll grow at a rate of 2%, going all the way on to the end of our projection here. Okay,
Yep.
that's going to bring us to the probably most important but least understood element of our entire projection engine, starting with the very first day that we launched the Roth projection engine, the single year one, which is the tax adjustment assumption for tax deferred accounts. We mark it as optional. You don't have to do it. In fact, we start with it off because it can be so confusing to people. But I think it's important for us to spend a little bit of time on here, particularly in light of the fact that we've removed a previously seen element of the Roth projection tool, which showed you if you have this much money in a tax deferred account, here's how much money you really have after the IRS, and for some people, the state, takes their embedded tax liability out, right? $1 million in a traditional IRA is not the same as having $1 million in a Roth IRA. Roger, and you guys at your firm, you talked about this really well. So, we're going to use this 24% assumption, but let's walk people through what does it mean to have 24% in this field?
Well, this is something, well, I don't know, you put me on the spot here. I mean, what we're essentially saying is you have to have some assumption. So if you have a Roth, let's say at the end of your life, if you could choose to have $1 million in Roth or $1 million in IRA, and that's it. I guess at the end of your life, you're dead. But like for your surviving spouse or your kids or whatever, if you could choose to have $1 million in Roth or $1 million in IRA, the answer is $1 million in Roth because you own 100% of the $1 million in Roth. If you own $1 million in IRA, the IRS owns some percentage, some portion of that. And actually, I haven't seen great literature on how to actually optimally estimate what that amount is. It kind of depends on what bracket your kids are going to be in. Kind of depends on what average rate you're going to be in while you're still alive. So we put an assumption in there. We kind of split the difference and we say 24, it's kind of in the middle. But, if this is a client whose children are in the highest possible bracket and they're optimizing for their children, for example, I would put a higher bracket in here. Because essentially what we're going to do here is we're going to use this amount to adjust any tax deferred assets. The graph you'll see, it shows like this is your total portfolio over time, and the Roth does this, and then like this allows you to say take everything that's in a tax deferred asset, and basically you're lopping 24% off of that because you don't really own that. The IRS owns that thing. Now maybe it's not 24, maybe it's 27, and maybe it's 22. We got to have some number though. And
Yep.
so this allows you to adjust that and kind of come up with an assumption. You're going to have to kind of think through the client situation. I wish there was better literature or, you know, academia study around what to put in here, but 24 is as good as anything. It's not zero. I know that much.
Yep. And I
Some
think the
amount is
challenge that,
owned by
yeah,
the IRS.
and this is why we make it optional, right? Some folks choose not to do this. I think, we would say as a best practice, you probably should. Now, how best you do that, that's where we're kind of stuck, right? Because the
Yeah.
reality is, like, your after-tax amount of your IRA kind of changes every year, right?
Right.
This year it's maybe the rate is 24%. Next year, maybe it's 30%. Maybe the year after that's 15%. You just don't know. But the ability to enter an a tax deferred adjustment on each year, too hard, right? So we just use this flat rate that adjusts the amount of a tax deferred account to
Yep.
show what would it be if you think about it, if you liquidated the whole thing, how much money would you have left over,
Right.
right?
And
After the IRS.
make sure you're comparing apples to apples. Because
Yep.
like I remember like in my old firm, we used a tool I won't name that I actually really, really liked. It was a cash flow based tool. It did everything really great except for this. And so it was very challenging for me to show to a client, I would show two projections and they look pretty similar, but the reality is one of them, all this money was in Roth, and the other one, all the money wasn't, but they just looked like the same $1 million in both cases. I had to do a lot of manual adjustments to pull back out the after tax piece. So that's why we built that into the software. You'll see, let's just get there, Ben. I mean, you
Yeah.
can adjust with and without that adjustment instead of
Yeah. Last
yapping
thing
about it.
here. Yeah.
Yeah.
Last thing here, we're going to leave this checked. We're assuming the 2026 rates sunset, right? So that's theoretically the end of the Tax Cuts and Jobs Act.
Yeah.
Stay tuned, right?
Stay
We'll
tuned.
learn more about that, but we're
Stay
just going to
tuned.
keep that box checked, assuming that they do sunset and we go back to the way things were back in 2017 before the Tax Cuts and Jobs Act. Now that's going to complete us. That's going to complete our assumptions here. And now we've got our projection tool, right? The control panel will have all of the information that we just entered. We can go back in here and change any of those assumptions if we need to, right? If we can come back in here, we see there's our Roth conversion. There is going to be one adjustment that we need to make because if you recall, we said that their spending wasn't going to stay consistent at that $120,000 forever. It's going to change in the year that Ryan was going to die in 2049. It's going to revert to $100,000, right? Which will
Again, we're
also,
using today's dollars there.
yep, that's in today's dollars. We hit apply, right? Because that's how the system's going to know, okay, use what you actually said. So here we
Mhm.
have this steadily increasing spending amount that drops down and then goes back up until Rachel's end of life.
Yep.
We have
There was a pension, was there not?
there was a pension, so that doesn't get added in that first section, but here we can add the pension. And we said Brian is collecting that pension 2024 for $15,000, no cost of living adjustment, but he does have a 50% survivorship, right? So when we click apply here, we'll see the income row for his pension drops down to 50%. Again, this is no cost of living. And so that will be what Rachel receives until the end of her life. We have this is actually exists in the 1-year projection too, but we've included it in the multi-year, but the ability to have an annuity, right? For those folks who have annuity income, you can have same process, right? You add a row. If there's inflation, you can add that. If there's a survivorship option, you can add that. So trying to think through the different sources of income that various clients could have, recognizing some folks have annuity, some folks have pensions, some folks have Social Security. These folks are retired, so we don't have it modeled here, but for those folks who are still working, same deal. You can have a wages row where you can have wages going for a particular period of time. When somebody was to retire, then you would have another row that says wages are zero. So let's just say hypothetically, we'll delete this out. Maybe if Ryan was still working and earning $150,000, No sense of inflation there. We'd have it apply. And then if we wanted to mimic when he was going to retire, let's say he was going to retire 2 years from now, we'd say 2026 and we'd have an amount of 0, right? So now we have 2 years of salary and then boom, he's now retired, right? Let's delete these out because we said we were going to use retiree here, right? Same sort of deal for Rachel going on here. Same windows apply. So we've entered all of our assumptions that we have to enter, and now we can come over to our right-hand side. And what we see is the results of our conversion. What you'll see at the top, and this is a relatively new addition. Again, this exists in the 1 year, and we've continued it over to the multi-year. We run the tax calculation that says your base projection, the total lifetime tax that you're going to pay, if you don't do any conversions, right? That's what base here means. No conversions is about $2.9 million of federal income tax. We're not modeling state in here. This is just federal income tax. If you do the Roth conversion, yes, you're going to pay more tax up front, but you pay for that by having less tax down the line. Total lifetime tax for the Roth projection scenario with those, what we say, like 6 or 7 years of conversions, only $2.2 million for a difference of about $761,000 in terms of total lifetime taxes paid, right?
Yeah,
So again,
credit
if
to our own customers for suggesting this right here, because I think a lot of our customers we were hearing on webinars and things like that, that people were building this sort of analysis on their own. And so we just built it into the product. It's pretty sensible to me. I think it probably hits home with certain clients better than say that chart below, that while compelling to me, like I see that the Roth has way more money at the end. And Ben, I don't know if we're adjusting for after tax dollars there or
not
not,
yet,
going
not
back to
yet.
our thing, but that's $761,000. That's admittedly that's not today's dollars, but some clients that may really resonate in a way that the chart itself, the graph itself may not.
That's right. And I want to take a moment here because I saw something on LinkedIn recently that I thought was an interesting comment, which was, for people who are doing this, how are you going back and updating things with successive years? Or how are you showing taxes saved? Which I thought was, that's an interesting thing to enter. What I thought about that was though, and pardon me if this sounds a little out of care, like who cares, right? Like what we're doing right now is showing a possible 30-year projection. It's wrong on its face, right?
Yeah,
This is not the way
it's
life is
directionally
going to be.
accurate. Yeah,
What we're talking about is directional accuracy. We are not trying to say to the dollar, how much of a difference are you going to be, right? Life is going to be very different for these people over the next 30 years.
right,
All we're trying to do is illustrate a concept. If you do this, this is a possible outcome. And the
right. With
size of that
based
outcome,
on these assumptions, right? I mean, it is like,
exactly.
yeah. Hmm.
Yeah. So, try not to confuse something like this with precision. We are
Mm,
looking for, are we directionally accurate in making an assumption that paying taxes now will pay off later,
right.
right? That's the concept we want to get across. And if we want to quantify that with these assumptions, you can do it. And I think that's a powerful concept, but do not confuse this with, if you do exactly what I say, you're going to end up with $10 million when you die,
Hmm.
right? I think that's a
Which is the
powerful thing
case
to
for
take
every
home.
projection we run, retirement projections. And I mean, there's no, yeah, there's none. All we know is that the number will not be exactly right. But
Yep.
we hope that the assumptions and the modeling is accurate to the point where we can tell the appropriate story to take the right action. And in this case, I'm looking at it, I'm like, I should do Roth conversions.
Yep.
I should do them.
Because, so let's tell there's a couple different ways. One of them is total lifetime tax paid, right? $761,000 less tax paid in our Roth projection. Well, how does that translate in terms of portfolio values? So we have two lines here, a green line and a blue line. The key here, and this is what it's telling you, the green line is your base case. Remember, that's no conversions. The blue line is Roth conversions, where we're doing those $85,000 of conversions for a series of years. At the start, even though it's hard to see because the scale here, we're looking at a $2 million difference in, an inch and a half. The base case starts ahead and stays ahead of the Roth conversion for a number of years, right? For about 20 years until at some point the Roth conversion starts to win out, and then it continues to win out over the course of these folks' lifetime to where you have a difference of about $600,000, give or take, between the base case and the Roth conversion. Now, because the scale is a little tough to read here, right? We're looking at $2 million increments. We've got this difference chart. And what the difference chart is doing, it's trying to highlight just the difference between these two. So you start at 0, the Roth starts below. So anytime this line goes below 0, the base case has a higher portfolio value than the Roth conversion case. At some point, we had a crossover spot at about 2046, 2047 in this particular case, and we're quantifying the difference between the two portfolio values. Played all the way out to the end, the Roth conversion case has a much higher, again, terminal portfolio dollar amount, right? So again, what we're trying to do is take what looks like it's not that big of a difference here because of scale and illustrate this in a little bit better way of just showing the difference between the Roth and the no conversion case. Here's our assumption table down below. Here's the things that we have. Now there's a couple of other sliders that you can put in here, right? You can show, if you wanted to, just the last 5 years, right? You can do that by hitting our slider here, hit apply.
We added that because in some of these pictures, it wasn't terribly compelling looking. So we made only the last 5 years, which usually is more compelling. Like that's a more compelling chart right there.
That is
Looks
a
like
more
there's more
compelling
real estate
chart.
between the two. Yeah.
That's exactly right. So, you can show it, you can not, it's totally up to you. The other one, and again, this was a user generated one. This was required minimum distributions. So if you slide that, you're going to see another chart show up down here that shows the required minimum distributions over the life of the client, starting here at our baseline of 0. And then this is a year that they have to start taking required minimum distributions. And we can see the difference in those RMDs over the course. And again, it should show us what you would expect, which is in the base case, because there were no conversions, there's going to be more inside that traditional IRA for there to be an RMD in every year relative to the Roth conversion case, right? So I think the last piece that we wanted to touch on, Roger, was what's the impact then of hitting this adjusted tax deferred box? Right. So when I do this, remember, what am I doing? I'm reducing my tax deferred assets by 24%. Right? I'm just taking a 24% cut, saying that that is the embedded tax liability for my tax deferred assets. And now you're going to see a much different story, right? In fact, if you do it this way, the Roth conversion piece starts out actually better and stays better
Always
all
wins.
the way through,
Yeah.
right? Because again, you're accounting for that tax liability from the jump all the way through. So, again, is this the way that it's going to look on somebody's balance sheet? No, but that's because somebody's balance sheet and their account statement doesn't have that embedded tax liability in it that is there, but it's only there when everything has to come out, right? So it's just a different way of illustrating what's actually happening behind the scenes, even though somebody's statement isn't going to show that, right? Roger, is there anything else that you wanted to add here before we jump back into well, what happens like 5 years from now when things might change?
I'm gonna just seeing some of the trends in the Q&As. There's a lot of questions about from our nerdier friends on the call, like how does it handle the fact that if you can't pay for the Roth conversion, does it pull from the IRA to pay for it? And do you take from taxable first in IRA? I mean, here's the good news about this engine that we have built here, okay? And again, I was hesitant to even get into this project to begin with because I was like, there's other products who do this sort of thing. There's one thing that we do really, really well as a starting point that I would argue is world-class, which is our tax calculation engine is very good. Like that's what we are, right? So at the base, at the middle of this entire Roth projection engine is a tax engine that I think is pretty rock solid. And I would argue could go toe to toe with any other product out there because that's what we do. I won't make any claims beyond going toe to toe. So that's really solid. Now, things like calculating RMDs. Yes, it calculates the RMDs. Does it do more conversions than you could do if it's, if you put in a conversion that's more than how much is in the IRA? No, it doesn't do that. Like it automatically figures out like if I need to raid the taxable account versus the IRA to pay for the conversion, it does that sort of stuff. This stuff is pretty, I was going to say simple, but it's just math. It's cranking through and it's code, right? The piece that we've been adding on over time. So that's like the core, right? It's rock solid tax engine, and then build the right assumptions around how RMDs work, build the right assumptions around how returns and how money comes in and out of accounts over time when you have to meet spending needs. Like that's a pretty solid core. And then everything we're building around that is, yes, multiple years. That's what we can do now that we couldn't for a couple years for those who've been using this tool for a long time. Adding things like the pension piece, the annuity piece, those are just flavors of income, and our calculation engine can handle those, right? So that's what we've been adding as we've kind of been moving farther out from that core. I saw questions like, well, can I model Schedule C or this flavor annuity or that flavor annuity? We'd have to look at your individual case that you're trying to model for your client. But the good news is the core capability is there. So as our customers tell us, like, look, it's really, really important to me to model XYZ charity scheme over the next 30 years. That's something I do for all my clients, and I do it in name of other companies' product. Yeah, we can build that because we already have the capability to really calculate that charity piece within the tax engine, probably more so than anybody else, right? So like behind the scenes, I can't just say trust me. Like you got to audit this stuff. And Ben, at the bottom, there's that little export button that people really want to audit, line by line, field by field, every single thing that comes out of this model, that's there. So can it do everything? No. Is the foundation strong? I think yes. And so we're able to keep building onto us. And we'll talk at the end of this call if there's time about where we expect to go with this tool.
Yeah, so this would be that Excel spreadsheet that
Oh, it's
Roger
lovely.
mentioned,
It's
right?
almost
So
as good as your first slide there, Ben, in terms of wordiness and
it's close. Yeah,
comprehensibility.
this one's
Yes.
got way more numbers, but so we're working on the same wavelength there. I think one of the questions that came up and that I'll address now, just in terms of next steps, Roger, was, I've seen a couple of questions of, does this only do federal tax? What about IRMA? We are already working on the ability to add in the income related surcharges.
Yep. Because
So,
again, that's
that
already part of our tax engine. We already have that built. So it's just a matter
exactly.
of wiring it into the projection on the front end.
That's
Super
exactly
easy.
right. So that will be coming in as an eventual next step. I think there were also questions about, well, can it tell me like how much to convert each year? Again, that is something that widely requested and something that, we should be able to provide. I won't make any promises about that, but right now what we're just doing is showing you, again, it's just the extension of that 1-year Roth to this multi-year Roth, but know that there are other pieces that now that we've got this chassis built, we can start attaching those other cooler pieces to it, right? So, what happens, I think this is how you kind of come back and forth, right? The story between the multi-year tool and then back to scenario analysis, because one of the questions was, well, if I put all this stuff in, if this stuff is in scenario analysis, is it automatically going to move over to the Roth multi-projection tool? And the answer is no, right? The multi-projection tool is not talking to scenario analysis right now, right? So, those elements that we put in at the front end, that's why we had to enter them again here, right? Those two pieces aren't talking to each other like they are with the 1-year tool. But if we wanted to go back to scenario analysis and say, okay, well, yeah, I've got this 7-year plan for these conversions. Well, what happens when I get to 2029? And in 2029, all I did here, by the way, I had these all banked up in my scenario bank. I just added this column. So I've inflated it to 2029. We've inflated their different pieces of income. What happens in a year where now they want to do like $100,000 of capital gains because they've got something new show up, right? The concept here is that we've got this cool projection, this $85,000 per year projection, but life happens somewhere along the way, right? So you might decide, okay, maybe this year they needed to take $100,000 of long-term capital gains for something because, I don't know, they wanted to buy a beach house or something else kind of came into the picture. Yes, that projection tool that we did, in this case 5 years ago, was helpful in giving us this concept of what would happen if they did these $85,000 of conversions. But now we might come in 5 years down the road and say like, okay, if I were to run range calc now, and again, we're going to come back to range calc, which I realize is dangerous in retrospect, but what we're showing here in 2029 is, remember now we've sunsetted the TCJA stuff. So our second lowest bracket is 15%. It's not 12% anymore. We've got this
Brutal.
big, this big capital gains in here. It's still, you could still take a $65,000 conversion and go up to the top of the second largest bracket over what it will be in 2029. But a $65,000 conversion in that year, again, we've already backed off the $85,000 amount, right? That's what we modeled before, but we modeled that knowing that these brackets were going to change. If we continue doing a $65,000 conversion with this $100,000 of capital gains, our total tax bill now is much higher, right? We're
Yeah, that's
looking
an
at
expensive Roth conversion,
this is now
right?
an
Yeah.
expensive Roth conversion. So this is kind of where you go this back and forth between, yes, this was the tool designed with what we knew at the time, but in any one year, your circumstances might change and you might have to back off of that conversion amount or accelerate it. Right. In this case, we might want to back off if the client says like, yeah, I totally get it, but I don't want to pay $30,000 in taxes because I have all these capital gains that I now have to factor in. You can tweak that $85,000 amount to come up with a dollar amount that's consistent with your story for that year based on, say, a tax budget. Or if somebody has a big charitable contribution that year, well, you can make use of that charitable contribution and maybe do more of a conversion than you once had, right? So it's this back and forth between here's our long-term projection tool very high level. And then let's go back into scenario analysis for a more detailed analytical look at what I want to do, what makes the most sense for this year in the context of that longer term projection. Right? Have I explained that
Yeah.
well, Roger? Does that make sense?
Yeah, the internal wording we use for these two types of planning. I haven't heard this otherwise in the world is strategic financial planning and tactical financial planning. These are internal Holistiplan words, but feel free to use them yourselves. The strategic financial planning are the projection based planning. If I have these behaviors over time, I don't have a ton of precision around it, but the idea, like Ben was saying, like have an idea that yes, Roth conversions are a good idea. And if I can fill these brackets in my lower income years, that's all going to work great. And we can show that to the client, just like we do with retirement projections. Like if you have this behavior and save this amount and have these behaviors, you're going to be okay and retire at 67 like you want to. That's strategic financial planning. There are lots of financial planning tools out there besides Holistiplan that you're free to use that allow you to model that. But then you get into the tactical financial planning, which is like when you're in the moment to actually implement the thing. And that's where Ben's talking about. Like in this case, our strategic financial planning, our plan was we're going to do Roth conversions every year that we're in a low tax bracket. Well, what happened was in 2029, we got to 2029, and the moment happened, and your client said, whoops, I just sold this thing and got a $100,000 gain. Well, you can't rely on the projection anymore because, like, that was just a high level idea. Now we're in the moment. We need to model it. And so that range calc that Ben showed, the range calc he showed, yeah, if I try to fill that 15% bracket, if you bring up range calc again, Ben, just because
Okay.
there's some people on the call who may not really know range calc very well. That big red blob on the left-hand side is saying that even though I'm in the 15% bracket for ordinary income, by bringing income into my tax year, I'm causing more and more of my capital gain to become taxable. So the effective rate for every dollar of Roth conversion I were to do in that level is actually 30%. And you're
Yep.
probably not going to do that Roth conversion if you mapped it all out at 12 or 15% ordinary marginal rates. So that's the idea, is that we've taken this into the tactical realm, and we're always moving back and forth. Like a good financial planner is moving back and forth. You're having your client make sure, okay, are we still on the plan, the strategic plan? Are we still on path, on track there? Are your behaviors and are my behaviors in line with that? And then the tactics get down to within the year, what have you done for me lately? Can we make sure that what we planned out to do actually makes sense? And in this case, it doesn't. In
Right.
this case, it's way too high. It's way too costly to do that Roth conversion, I would argue, because it's actually 30 cents on every dollar of Roth conversion that you do in tax.
Yep. And technically, it's probably even a little bit higher the way that some folks think about the cost of the conversion. We saw a lot of questions about IRMA within range calc. That's what these vertical lines represent, right? These are the
Yes,
thresholds where if you go over by $1,
good
this is
point.
the surcharge that you add for parts B and D on a per person per year basis, right? So, yeah, this would take us up to the top of the bracket, but maybe our clients hate the concept of paying IRMA. So you would go way lower than what, we had originally modeled. And so again, to all those questions, yes, we are working on factoring IRMA into the Roth projection piece itself. IRMA does show up in range calc. It does show up in scenario analysis. It doesn't add to the total tax cost because, as we've explained a few times, IRMA is not technically an income tax, right? It's a surcharge on Medicare that shows up 2 years later. So like, when is it really due? Actually, I would actually say the fact that we can now do the multi-year projection allows us to show the cost with IRMA involved, right?
Right.
It's a
The
backdoor
1 year
cost
was kind of like it
in a
wasn't really
1 year
part of the
situation,
picture.
right?
Yeah.
And even within scenario analysis, you're showing the income taxes for this year, but you don't pay IRMA until 2 years later, right? Because Medicare works on this 2 year look back. So how do you
Yeah.
really factor in the cost of something that you don't actually have to pay for another 2 years? But with the multi-year projection, we can actually at least include that as a excess cost, right?
Yeah. Yep.
All right, so we are coming up on the end of time. There's no possible way that we could get to all of the open questions that are
Yeah.
in
Our
the queue.
colleagues have been doing a good job answering some. And of course, this is recorded. And of course, we're here as you play with the tool. We can answer questions as you go along.
Yeah, but anyway, we are super excited about this. Again, check out the article to turn out how to turn it on. It's really, you just have to go to your firm customization and security settings. If you are not sure, write into the folks at support, click on the support or any of the help features inside of Holistiplan. The best way to do it is hit the contact support button right here, type in your subject and a question, and it'll come right to the support desk. But you can also access the, if you go to the help menu, the knowledge base right here, and we just type in Roth projection. First one that'll come up is our multi-year Roth projection tool. All right. So with that, we're going to say thank you to everybody. We appreciate you spending a little bit of your short Thanksgiving week with us. Have a great holiday, and we'll look forward to talking to you next time. Take care, everybody.